ahead and get started. I'm Shauna Fleischbein with Castle Group, and I'm joined today by Laura Bryant, my colleague from Naples. And we're going to moderate today's presentation, but we're going to let our panelists here run the show. So Laura, I'll hand it over to you for now.
Hey, thank you so much, Shauna. Again, my name is Laura Bryant. I am the Business Development Manager here in Southwest Florida for Castle Group. If you're not familiar with Castle Group, we are a full-service on-site property management company. Should you have any property management needs or any questions, please feel free to reach out to Shauna or myself. We'll be happy to help. I'd like to introduce Bill. I do not want to butcher your last name. I should have asked you before we started. But Bill, I'm going to let you introduce yourself. Bill is representing Hafer, and then we'll go through and let everyone make some introductions and tell a little bit about yourself and your companies, and then we'll get started with today's discussion.
Okay, great. Good afternoon, everybody. It's Bill Kilgallen with Hafer CPAs. Our firm serves over 600 associations. We provide audit, tax, and even consulting services. So most people ask, well, you know, what do I need? Do I need an audit? Do I need a review? For financial reporting purposes, if your maintenance fees for your association are going to total 150 to 300,000, that requires a compilation that you're going to need to have done. 300 to 500 requires a review, and 500,000 or more requires an audit. So if you're looking at asking what is a compilation, well, the CPA firm in that, in that particular situation is going to convert your general ledger data that's provided by the association into like a financial statement format. So you're going to be able to see the revenues and expenses of the association coupled with the balance sheet or the fund balances, if you will. And it's also known as a write-up in the parlance of accounting. Under the $300,000 to $500,000, that requires an actual review. So the CPA is going to make inquiries relating to the accounting practices and the principles that are used by the association. We're going to perform some high-level analytic procedures to understand what the current year balances are to the prior year, and also look at any balances that we think don't meet our expectations for the current year and take a deeper dive at them. In the case of an audit, the CPA is required to obtain evidence through inquiries with the personnel that's, managing the books and records, a physical inspection, a verification, and substantive testing of procedures. So they're going to examine source documents, for example. They might be invoices, confirm balances. They may be bank balances, review legal matters. What's the standing in the association right now? Are there any pending suits? We're going to do analytical and other procedures to get us comfortable that your financial statements fairly present the status of where you are. Now, a lot of questions come up during the budget period, which is what we're starting to enter right now. Can an association waive the financial reporting requirements? The answer is yes. They must be approved by the majority vote, though. There's also a fun fact that goes with that as well, too. If you fall into any one of those categories, the board does have the ability to decide to take a step up. So if you fall in within the compilation area, the fees for compilation, you can actually request a review in lieu of a compilation. So in the month of August, we're going to see associations begin their budget process. Obviously, there's going to be more of a focus on budgeting for reserves. Why? Well, due to the Surfside tragedy, we're seeing associations undertake more reserve study updates. Potential buyers, we think, are going to be looking more closely at maintenance, special assessments, and reserves. And we expect to see a change in associations in partially funding versus fully funding, and also the special assessments that go along with that. Another area that we're seeing as well, insurance premiums are on the rise, not only probably on your individual policies at your house, but also within the association. We're looking at considering, asking associations to consider higher deductibles perhaps, and adding on a line of credit to cover that, or else maybe even financing the annual premium amount. I know that we're going to have a few questions about the pooling versus the statutory reserves. The pooling is funding for multiple assets that we combined into one general account or pool of money, if you will, and the expenses are going to be paid out of that same pool. Component reserves. Each asset is analyzed separately and has its own dedicated reserve account. So the roof special, the can everyone hear me?
Yes.
Okay. So each asset's analyzed separately, and it's got its own designated reserve account. The funds aren't transferred from one category to the other. That's the big difference between the component reserves and the pooled reserves. So if you opt for the component method, also known as the straight line method, you're going to calculate your contributions for each category and keep the reserve funds separate. You may have one account for pool maintenance, for example, one account for landscaping, one for roof, and so on. Funds are not shared between those accounts without a majority vote from the HOA or the COA board. The pooled reserve method, though, is a better option because it allows for more flexibility. And we see a lot of associations now moving toward the pooled reserve method. The funds aren't restricted to one specific account. And to ensure that your reserves are going to be fully funded, you've got to consider many factors: cash flow, your current reserve balance, inflation costs, and the projected cost of all the repairs and replacements that you're going to anticipate needing. But it maintains flexibility in the case that one project costs less than anticipated and another project costs more than what's anticipated. As I said, many associations are opting for the pooled reserves. It's simply fairly distributed. It lets you build up your reserve fund smoothly and gradually over the years. And according to the association reserves, most reserve study professionals, they recommend the using pooled reserve method. However, the component method can be a good choice for some HOAs, especially if you already have some reserves set aside and you do a great job analyzing and calculating the contributions for each special component. And if you're using the component method to fund your association's reserves, but you end up frequently moving money from one account to the other, you may be essentially using the pooling method, and it might be the simplicity of then going to the one general fund number. And so a condominium unit needs approval from the unit owners at a majority meeting where there's a quorum to put existing straight line reserves into the pool. And once that's done, that's it. Trending right now, we see a sale of common area property. We see a sale or a lease of antenna rights on the roofs. And we see obviously associations that are renting units that have been obtained in foreclosure. All of those different aspects contain a tax, if you will, effect on the association. Will they need to pay tax, or can they get that as a tax-free, I guess, tax-free benefit, if you will? And depending on the facts, it could be tax-free to the association. For example, if it's a sale or lease, will the proceeds be marked for future capital expenditures? If that's the case, that's where you'd want to start to dive into whether or not the transaction could be constructed as tax-free. So talk to us if you've got any questions whatsoever in the budgeting process. We're here to help with questions, share best practices, and obviously answer the questions that you have today. Thank you.
Thank you, Bill. There was a question that came in, if you recommend a portion of the fully funded reserves be invested in anything other than CDs.
We have quite a few associations that go out and they invest in those reserves out in the marketplace. And generally speaking, I would say that probably 95% of the associations play it very safe and they put them into CDs or the like. Investments in some cases can work out for you. In other situations, it may not give you the flexibility to monetize it quickly, nor with the market fluctuations up and down, give you the desired results, especially if it's going into your principal.
Okay, and one other quick question is, out of the percentage of condos that you maybe have in your portfolios, how many are fully funded in their reserves?
I would say that there's probably close to 60% are fully funded. I think there's been a trend in the past, certainly 3 or 4 years, to discuss how important it is to have those reserves, and especially in marketability of your particular unit. People now are more astute, and they're looking to, purchase a place that has those reserves built in, so that the value of their property is higher and they're not surprised when they move in with a special assessment. So I think that boards are realizing that now. And I think obviously the Surfside tragedy is going to just increase that more.
Yeah, I'm sure Keith can chime in. I'm sure we'll see something, from legislative side of it that will come down in the next year. So let's go, Jason. I'd like to come on to you and introduce yourself and about your company.
Sure. Thanks very much. My name is Jason Nesselrode. I'm with Assured Partners Insurance. We specialize in community association insurance. So I think right now we have about 4,000. We insure about 4,000 associations throughout the United States. We have offices in 38 states and 2 countries. And, this is one of our specialties. So I know the big topic right now on everybody's mind is, what's going on with insurance rates? Everything just seems to be going up dramatically. We've had associations where they're getting 10 to 30% increases. And a lot of that has to do with how our property insurance market is in Florida and how it's set up. We don't have a lot of insurance companies that want to do business necessarily in Florida, and even less that want to insure commercial residential property. So your condo buildings and HOAs, there's a lot of risk that comes along with it. And a lot of it's all packaged together. So what's kind of happened over the last 20 years, once the Nationwides and the Allstate insurances and State Farms kind of left the state as far as insuring condominiums, we have a lot of other Florida, I call them kind of startups that started within the last 20 years. So and these are the insurance companies that are required to follow Florida laws. They have to submit rate changes to the state, things like that. So they're really kind of the primary companies operating here. And the other option is to go with surplus lines companies, which are located outside of Florida. Now, one of the big differences with those is admitted insurance companies are backed by FIGA, the Florida Insurance Guarantee Association. So what that means is if the company were to go insolvent, you have protection from FIGA. I'm not sure if anyone out there was with AMCAP, American Capital Insurance, and saw what happened with them earlier this year. But a lot of their unpaid claims went to FIGA, and that's where associations had to turn. But they had that backdrop to kind of help them out. The difference is with surplus lines insurance companies, they're not backed by FIGA. But the one benefit that I would say they have going for them is most of them have, AM Best A ratings. So they're they're financially rated well, but they're also much more capitalized. I mean, you're dealing with companies like Lloyd's of London and some others where it's, they have over $2 billion in assets. So in my opinion, sometimes they're almost better off handling property insurance for an association in Florida than some of our admitted insurance companies are, which is why some of them are failing right now. And the reason why that's happening is because of all the claims from Irma, but also a lot of these Florida companies do business in high-risk hurricane states like Texas, Louisiana, South Carolina. So all the risk is in one kind of, high danger zone, I would call it, within these states, because we're all prone to hurricanes. So what ends up happening is reinsurance rates come in. So to talk about reinsurance a little bit, just to kind of simplify it, when your association buys insurance, essentially what you're doing is you're transferring your financial risk to the insurance company. So hopefully the bulk of claims won't hit the association's balance sheet. So you're transferring that risk to the insurance company. what all insurance companies do in some capacity, either through buying reinsurance or other avenues, is they transfer that risk to the reinsurance company. Well, last year, what happened is, due to all of the catastrophes all throughout the United States and the world, reinsurance rates went up drastically. And insurance companies are for-profit businesses. So what ends up happening is that additional cost gets passed on to the consumer, the association in the end. And that's kind of what's going on. And what's driven a lot of this, especially with IRMA, is assignment of benefits where, and again, there's a ton of great contractors out there, but there's also some contractors that don't mean well, and they basically use the IRMA situation to profit. And what happens is they would have associations sign assignment of benefits contracts. And what that does is that transfer the rights of your insurance policy over to the contractor. So now it's just them dealing with the insurance company. So if there's an issue and it has to go to litigation, you have no control over it, and your claim can balloon up. So you could start with something that's, say, $100,000 claim, and end up in a situation where that claim's been inflated to $300,000 or $400,000 because of all the litigation and attorney fees and everything else that's going into that. Some things to be cautious of. One of the big things that I see going on in the marketplace right now is property insurance for associations. A lot of it's getting transferred over to surplus lines from admitted carriers. And the reason for that is either the admitted carriers in Florida are at capacity and can't write any more new business, or they just can't, their model won't allow them to take on anymore. So they're either non-renewing people or making significant changes to policies. So one thing that I just want to caution everybody on is there are changes in coverages a lot of times when you go from admitted carriers to surplus lines. So one of the big things I've been seeing is companies starting to restrict replacement cost on roofs. So instead of getting, paid replacement costs for what your roof would cost to replace, they're starting to put actual cash value on policies. So be very cautious of that. I would actually encourage everyone to ask your agent to verify that the roof is being settled at replacement cost and not actual cash value. Because what actual cash value does is it factors in depreciation. So that means every year old that your roof is, it gets depreciated. And so if your roof is 15, 20 years old, that's a significant amount of depreciation you have to be cautious of. The other big thing, and I'll mention this because it's probably playing into the Champlain Tower situation, is ordinance or law coverage. In particular for older buildings, make sure your property policies include ordinance or law coverage. Because if you think about Champlain Towers, what happened with them, half of the building collapsed. Well, they still had to demolish the undamaged portion of the building and then remove that debris. And then they would have, if they were going to rebuild, would have, to bring the building up to current codes, which is going to cost extra money. This is where ordinance or law comes in and helps you out in that avenue. And the last thing I really want to talk about is wind deductibles and how they apply. With wind deductibles, be very careful when you go from an admitted insurance company to a surplus lines carrier, because usually what happens is in most cases, the admitted carrier is offering a calendar year hurricane deductible. And what that means is within the calendar year, no matter how many hurricanes happen, you're only going to pay up to what that deductible amount is for all hurricane claims in that year. And it's specific to hurricanes. So we're not talking about tornadoes or other types of wind. And what happens is a lot of surplus lines carriers, they'll either do a wind hail deductible, which they'll base on the total value of all the buildings on the property. So your percentage deductible from 5% is much bigger if you apply it to the whole property versus just applying it to one building like the calendar year hurricane deductible works. Sometimes they'll put things like named storm, which is every named storm. So not just hurricanes, but tropical storms, wind, and or tornadoes. And what they'll sometimes do is put an all other wind deductible on there, where if it's not a named storm, you could still have a $25,000 deductible for, things like tornadoes and hailstorms. So just some things to keep in mind. Again, I like what Bill said as far as if you're looking to increase deductible, money's pretty cheap to borrow right now. Looking into that line of credit to help fund higher deductibles, or, we offer financing options too, so people can finance their whole premium as well. But that's about it for me.
Good. Wonderful. Thank you.
Jason. We did have one question come in so far for you, Jason. Is there any advantage in having 2 or more brokers solicit insurance coverage for our HOA? So can you explain how the agent of record works and how that works?
I see that you're familiar with that, Shauna.
Oh, yeah.
Yeah, I mean, when it comes down to it, most insurance agencies are working with the same insurance companies. And what happens is a lot of these insurance companies, they will only reserve their market for whoever the first agent is that gets in. So what'll happen a lot of times is as soon as agents, have an association take a look at their insurance for them, they start submitting it out to all the markets that exist anywhere they can find and hope they find a hole in the current agent's marketing. And, to be honest, I've seen it work a couple of different ways. Sometimes you run into a situation where you find out your current broker isn't really marketing the insurance each year, and just kind of letting it go on autopilot. So you're maybe not getting the best option. But what I would encourage associations to do, and the way that I think is probably the best way to do it, is to actually interview the agents that you're considering marketing your insurance with. Take a look at their background, ask for references. But make sure that they're a specialist in community association insurance, because it's a very specialized area. It's, it's very different than insuring a lot of other businesses. So just make sure you're working with a specialist. And I don't think it hurts if you want to send it out to 2 agents just to kind of get an idea to make sure, keep your current agent honest. But at the same time, hire an agent that you think is going to be best for your association, has the experience, and can help you through things.
Yeah, I would also say make sure you have an agent that's going to actually come to your association. Yeah. Don't just do an email, here's my policy, what can you do, go to market for it if they haven't been, because they may find that there's exclusions if they come to your property and, or they're doing a site tour, they can be like, wait a minute, you had gates and I look on your policy and you don't have any gates insured. Yeah. You have perimeter fencing and this wasn't insured. And that may be because it had been added throughout the years. So definitely find an agent you trust, find an agent who will come to your property regularly. I would say at least annually to see if there's been any changes as he's looking at your policy prior to renewal date, he or she. Just make sure and if you add anything, contact your insurance agent. If you've done, a renovation and or addition to your amenities, please, reach out to your agent, let them know that you've changed some things and you need to make sure that they're covered.
Yeah, exactly. And I mean, what we're digging through everything. So we read through policies, we're reading through the association's docs, we're reviewing financials to make sure the crime insurance is adequate. So there's a big process that every agent should be going through. Hopefully most of them are. But that's going to uncover some things that, if you do have issues, we can kind of point those out to you and show you how to fix them.
So
just to dovetail on that real quick, Laura, it's important that when you're getting to that point, that make sure that the associations are doing those replacement cost assessments every 3 years, because those are well worth doing because they serve multiple purposes.
And I would even encourage, just to play off of that, but I would encourage considering an annual update program, because especially right now, I don't know if anybody's been paying attention to what's going on with building costs and inflation and everything else, but the last time you had your association had an appraisal done was, 2 or 3 years ago. You may want to actually look at updating that because you might not have adequate limits.
Yeah, I don't know that we'll see prices come down anytime soon right now.
Yeah.
Hey, Jason, I've got a quick question. One of the things that we see as questions in some of our associations is a D&O insurance. Mm-hmm. Can you comment on that and what you see as a trend there?
Yeah, D&O insurance, as far as from a rate perspective, it's not really going up much. As far as, markets that are out there right now, we haven't really gotten any new markets into the marketplace. A couple of the big things that I would mention with D&O insurance, one would be make sure, especially if you're a larger association, make sure your defense costs are outside the limit of liability. So a lot of times what you'll see is, your association will buy $1 million of insurance coverage. And there are some carriers out there that have defense costs included within that $1 million limit, which what that means is if you had a bad claim, the most they're going to pay for defense costs and for the settlement is that $1 million. So it's usually not much more expensive to find an insurance company that will include defense costs outside the limit of liability. And the last thing I would say too is don't move it around a whole lot. With D&O insurance, you have a pending and prior litigation date where prior board members and things could have been aware of things, but never made the new board aware of things. So try not to move that policy between insurance companies too much.
Yeah, we've seen a couple of them actually lose the insurance and had to go to a different carrier because of some of the suits, the owner suits.
And sometimes that happens. And if they do end up with a market where defense costs are included inside the limit, there's one or two markets out there that will allow them to buy an additional $1 million just in defense costs, which is really cheap to do.
Perfect.
Thank you.
Well, Jason mentioned making sure that you find, insurance agent who specializes in associations. And we want to do the same thing when it comes to your attorney. Make sure that you find an attorney that specializes in associations. So without further ado, we will hand it over to Keith.
Thank you, Shauna.
You're welcome.
Good afternoon, everyone. Accountants, insurance, and lawyers. Who is excited? My name is Keith Skorowitz. As Shauna said, I'm with the firm Appleton Reese. We're based in Tampa. Our practice is hundreds of associations and condominiums from north of Orlando down to Naples, kind of following the I-4 corridor. Our areas of practice is the condominium associations and homeowners associations, corporate governance, amendments, rules, financing. Shauna was nice enough to share some of the comments that came in, the questions that came in before, and I want to kind of try to fit some of these pieces of the puzzle together. Everybody is concerned. I'd say a good third of the questions I received, Shauna and Laura, were about what's going to happen with the legislature going forward. So let me kind of start there, and then I'm going to lead into the 150 pages of statutory changes that happened, that went into effect on July 1st, which I'm sure Laura and Shauna are just so thrilled to have to change internal processes. And I'm going to do kind of an overview, folks. I'm not going to do a deep dive. If you have follow-up questions, you're certainly, you can call me or email me. I'm happy to answer your questions. A lot of this stuff is still going to be on the fly, but I'll summarize one of the big questions that was asked. It was, how likely are the condos going to be subject to that 40-year review? Everybody keeps hearing about this 40-year review that occurred with respect to Surfside. And I think those of us who are on the call today, whether you're in a homeowners association or a condominium, whether it's a high rise or a mid rise or a villa type, I think you can expect some sort of change that the legislature, in our area of the law, we believe that they will overcorrect. I want to give you some hope in that the Florida Bar, our section of the Florida Bar, did create a special committee to report to the legislature on how best to deal with this. There's issues of power, there's issue of voting. It's not just pure issues of finance, because the finance is really the last step. So do I think that the legislature will overcorrect? I do think that they will. I think that as Bill said, in terms of getting ready for budgeting, as you enter those conversations, there ought to be a line item for those of you who have substantial assets, whether it's clubhouses and pools or golf courses or whatever, restaurants, high rises, common elements. You should be anticipating at least increased engineering costs to be able to demonstrate to authorities that your building and your assets are sound. I think that's probably a good starting point, because we won't really know until the legislative session gets underway, and then we see what happens going forward. But That's kind of dovetails with, well, how do we protect our finances? How do we keep things? How do we stay fiscally sound heading into kind of a little bit of uncertain times? As I mentioned earlier, there's about 150 pages of legislative changes that went into effect for both condominiums and homeowners associations on July 1st. Not the least of which is a drastic change in the collection of past due assessments. If you've got a past due assessment problem, or you are anticipating one, if you're seeing an increase, first thing you need to do is you need to get with people like Shauna and Laura. You need to get with your manager and truly understand the state of your finances. Second thing you need to do is, are we now complying with the new law that requires a notice of late assessment go out? Is very limited in what you can put in that letter. It has not been flushed out. That new law probably raises more questions than it answers. I understand what they were trying to do. And third, if you don't have a past due collection policy, if you're with Castle, I'm assuming that you do because you are well taken care of, you should get with your manager, get with your lawyer, go over your documents and get a good policy in place so that you really start to understand what the status of your income, the only income stream you have is from your assessments. So that's really something you want to take a look at because that law changed. This is a good time to kind of go and do a review of that. There are some changes to the definitions of governing documents and how you do amendments. I bring that up because we had multiple questions about reserves and what should be reserved and straight line and pooled. And it's important that you understand that sometimes you may have to amend depending on what your documents say. You want to understand that process. Again, it's a really good time to kind of do a deep dive into your documents if you've got questions, or if you've had owners start to ask those questions, particularly in condominiums, because again, there's probably going to be increased scrutiny from the state. I do want to say, I had a few questions. I don't know that I can possibly do a presentation these days without saying the C word, COVID, but someone asked, what if we're in a tower and we have an elevator and somebody's tested COVID positive, or at least you think that they have, and they continue to use the common elements? Well, they're still allowed to use the common elements. As a matter of fact, the new legislative changes to 718-1265 actually said an association cannot prohibit owners and their guests from accessing the unit and the common elements for ingress and egress of the unit. Now, depending on what your documents say, I don't want to make this about a mask fight, but you could certainly impose rules in the common areas and how to use them, just like rules in the gym about use times and so on and so forth. But that's certainly going to be a very specific question that will be document driven and depending on the culture of your building. I just want to raise that because I did see some of those questions come up. That was also part of the new. And again, I don't know how many, Sean, I don't know how many folks we have on the call or in condominiums, but I've had a couple of these questions come up. A few years ago, the legislature added electric vehicle charging stations that you had to allow owners to do that. I say good luck implementing that, but not because that wasn't easy enough. They are now allowed to do natural gas in condominiums. So if you're getting those types of questions from your owners, and if you're seeing as many Teslas as I see, it's certainly going to be something you have to wrestle with. And you should, again, I'm a big fan, as Sean and Laura know, I'm a big fan of adopting policies, getting in front of it before those requests come in, so you're not scrambling to try to comply going forward. I don't want to bore everybody with the other thing, big thing I wanted to talk about is, if those of you who are in a homeowners association on the call, there was some substantial changes to leasing restrictions and the types of amendments that apply to those leasing restrictions. Suffice it to say, if you pass an amendment that regulates for a term of less than 6 months, it'll apply to all owners. If you go greater than 6 months, those regulations will only apply to those who agree. So if I've had quite a bit of those issues come up with the influx of folks coming to Florida and my bigger communities. So if you've got those issues, again, get with your manager, get with your lawyer, go over those documents. So I don't really want to take too much. One other thing on COVID, Shauna and Laura, and this is a good way to tie this off with the accounting and the insurance. The legislature in 76838 did severely limit liability to business entities, which include associations, for COVID claims. Basically, it's a personal injury claim. The standard is so high because you've got to have a physician affidavit attesting to the causation of the plaintiff's illness. I haven't seen them yet. I'm not saying it's not coming, but as we head into this Delta variant, I've had kind of the same questions I had last April are coming into me now. What do? We do enjoy some more civil liability, but again, you've got to take certain steps in complying with government issued healthcare standards. So I'm happy to answer questions. I know I don't want to take up too much time, but I'm happy to answer some of those questions, Sean and Laura. I can drone on forever.
Yeah, Keith, there's a question that came in regarding the COVID vaccine mandates. Can a board require staff to be vaccinated now that there's FDA approval?
It depends on whether or not the association is an employer. That's an employee-employee question. Typically, Laura, as you know, a lot of those folks are on site, are employees of the management company. So I can't answer that question. You really need to kind of figure out what is their status first, and then coordinate with the policy of your management company.
So if they're self-managed, what would your recommendation be? Obviously,
as an employer, they could require that, but I would get with your lawyer first.
Yeah.
I'm busy. I'm not looking for work to do. I'm terribly sorry that COVID happened, but it's a minefield, and as we all know, it's become political if you've been watching the news. So I'm trying to help my clients navigate not only the law, but the appearances and what the message says.
Yeah. And we had another one that says on that same line, can an association require outside contractors to be vaccinated?
If they're entering the common elements, I would say yes. Assuming you don't have anybody under the age of 12.
Yes.
And that's a tough one. And that's a tough one because different areas, Dixie County has different availability than Palm Beach.
Yeah, that's true. Yeah.
So
under 12, I think you're going to get into some child labor laws there, Keith.
I kid.
We've got a whole other level of law there. What else we have coming, Laura?
Keith, one of the tenants in the building that we're in is a financial institution, and they actually are requiring anybody that comes in and does cleaning or any type of repairs in it to either be vaccinated or they're not allowed in. Yet, obviously, their clients that are coming in, they're not even asking them if they're vaccinated. So I thought that was interesting.
Bill, you're right. It's enforcement, right? It's the exact same thing as the violations for the incorrect paint color or anything else. If you are not enforcing it, it doesn't matter what your policy is and who's doing the enforcing. Is there somebody standing at the door looking for cards? How well are they trained? How do they know how to do that job? What are they looking for? Is vaccinated mean fully vaccinated? Do they have to have both? Do they have to be outside the 14-day window after the second dose? I mean, these are all, I think it sounds good on CNN, but implementing it for folks who don't do it every day, whether it's in a commercial condominium or a residential pool hall in a condominium, it's very difficult to enforce. Who's doing that?
Yeah,
because I can promise you, COVID enforcement is not in your management contract.
Right. Yeah. So one of our best practices is relying on what the CDC is saying and the recommendations, and then what your local county. So again, Hendry County would be different from West Palm or Broward or Miami or Collier or Lee. Everybody's a little bit different. So follow the recommendations of the CDC and your county, and it kind of keeps the board. I mean, you're doing the best you can with the information that you have. And if the CDC goes back and says, we say that vaccinated or unvaccinated need to be masked and socially distanced, then we're following the best recommendation from the information we have. What do you think about that, Keith?
I think that's great because that actually hits on the new liability protections for under 76838. You have to follow a controlling government issued healthcare standards for guidance, for example, CDC. So, and it's a little bit like the shifting sands of time right now.
Mm-hmm. Oh yeah. Yeah. And it will be for a while, I believe.
And for those of you on the call who have food facilities like restaurants or bars, you have a whole nother set of standards.
Yeah. So, well, on that note, should we move on to some other topics other than COVID? What do we have here, Laura? Let's see.
I did see a question that was interesting to me. It came in prior. It said, our documents state owners are responsible for windows. Are skylights considered windows as well?
Oh, yeah. That was a good one.
Yeah. So
is this a condominium?
Yes, I think, yeah. Yes. It was condo.
Yeah.
So that raises a couple of issues, right? Were the skylights installed by the developer at the initial build? If no, at some point those things were approved by a board, or they're unapproved because you had to go through the common elements to get to a unit to put in a skylight. So it's so funny. I'm laughing because I've had like 5 of those in the last 6 weeks, questions about skylights and going and roofing and where does the unit end. And I hate to give a lawyer answer, but a window is not a skylight, and it's going to depend on whether or not some previous board approved that installation and what conditions was that approval given under. I've seen associations approve the skylight, but they sign a waiver that says, look, if this thing leaks or causes damage to the roofing system, it's on you. If we need to reshingle, you have to take it out and put it back in. Mm-hmm. Here's a license to use the common elements to get to your unit through the roofing structure. So I think you have to answer the very first question you've got to answer is, was it installed by the developer? If it was installed by the developer and it's not addressed by the documents, and the definition of unit doesn't include the skylight, depending on how the definition of unit reads, it's probably a common element, but it depends. You guys have heard me say this before. Every deck is like a snowflake. They're all different.
True. Yeah. Yeah. In this case, it looks like they were put in by the developer, and we're saying our documents state unit owners are responsible for all windows. Are skylights considered windows?
I would say no. That would be transmogrification of 2 different nouns. But again, I'd look at the definition of unit, right? If the definition of unit is drywall in and ceiling down and unfinished floor up, mm-hmm. everything else by logic is a common element, unless accepted out in some other part in the declaration.
Under what circumstances may the board deny an application for a sale or rental? And is there a need to do background checks if there are no legal reasons to deny an application?
My first question is, why are you doing background checks? And what are you looking for? And what policies do you have in place? When you do those background checks and you deny a sale or a lease, you set yourself up for a Morgan & Morgan claim for violation of fair housing laws. I tend to be very conservative on this issue. Unless it's a specific conviction for certain crimes, you have to ask yourself, you have to ask, where are you getting the power to do background checks? Is it in your documents? Do you have a published policy? Because if you don't, you're already stepping in it. So the answer is to that, there's very few conditions under which my advice is going to be, I don't think I've ever told a client to deny a sale or a lease. Because I would ask you, why are you doing it? You don't like them? You don't like the color of their skin? And I say that seriously because every board is different, and it's my job to keep them on the straight and narrow. And you have to look at your articles of incorporation and your bylaws. What powers do you have? Does your declaration allow you to even do that? Some of the older decks, they do that. They have that purported power. But if you deny a sale, you better hope that they don't have a lawyer on the other side.
I was looking at a question. It's probably going to go to Bill. Our associations, where was it? are bids required annually for services for the association if they exceed a certain percentage threshold of the budget?
The answer to that is yes, but it's opened up to anyone that wants to put out a RFP, if you will, for any one of the services that might be provided. It's up to their discretion as well. But yes, over a certain amount, it's in the docs.
But it's not required by statute to have to do it annually.
Correct.
Right. Okay.
You know what, Bill, there was another one I was actually going to throw at you. You may have covered this in your portion. So if you did, then you can pass on it. But it was, what is the process to move from straight line to pooled reserves? Did you cover that already?
Yes.
Okay, perfect.
So they need the initial approval of the unit owners to move to that. And once that's done, they can actually move forward with the pooled. Okay. You know, one of the things that I did forget to mention that's kind of important with the increases on the anticipating in special assessments and or reserves is the fact that owners can get an increase in their basis. And we were talking about this yesterday, you know, before our presentation, and it's considered a special assessment and or reserve funding is considered a capital contribution by the owners. So why is that important? It's important because it goes to increase the owner's basis in their property. And so most of the people down here are snowbirds. And so when they go to sell their property at some point in the future, what's going to happen is that gain is going to be taxable to them because it isn't their principal residence. But any contribution that's made via special assessment and or a reserve increase goes to increase their basis. So if they were going to go to sell, it would be their original purchase price for their unit or their home increased by any special assessment they've paid since they've become owners, and also obviously any improvements that they've made within their property. So it's important to keep track of that. In the event that you do sell, you'll be able to lower the amount of the gain that you might otherwise have.
Great. Hey, Keith, a question on committees. It's two questions. What's the proper way to form a committee for an association? And then should committees give notice of their meetings to the members so that anyone can attend?
So that's a great question. First place to look is your documents. Typically your bylaws will allow you to form a committee. If not, you can pass a resolution with a charter to form the committee. You certainly want, and you, again, get with your manager, you want to outline the bounds of and the scope of that particular committee, whether it's finance or grounds or they're investigating a new roof, whatever it may be, you certainly want to put bounds on that. So the formation is really, look to your documents. Typically it's a board vote. Certainly want to do a charter to line that up. And what was the second part, Laura?
Do they have to give notice of meetings so that anyone can attend? Committee meetings have to be noticed if you're going to make some sort of final decision to spend money.
I typically will not put that in any of my clients' charter committee. I don't know what you folks do. Certainly that's an option, but I like to put a very fine line on that and leave that to the board so you don't have to keep track of, do we have to notice or don't we have to notice? Typically those committee meetings are getting together, they're doing an RFP, they're gathering all the information to help the board make a decision. So the answer is yes, you have to notice them under certain circumstances, but I don't advise letting committees approve spending money. It can be cumbersome to deal with.
Here's a go on this, Keith. This is probably you as well. Is there any restriction on recovering monies for damage from residents or their guests? Fines are limited, but is this? So
this is the prime example of this one is the gate strike. We see those all the time.
Yeah.
I literally before this call just sent an email to a client on this very issue. Unfortunately, for part of it depends on the level of the damage. Unfortunately, for an association, some damage is to be expected. It's part of owning real property. You can certainly file a claim, an insurance claim, to try to get the money back, depending on what your deductible is, or you can file a property damage negligence lawsuit. It's not just fines. Depends on what it is. If it's a major, somebody drove a car through a retaining wall and it fell down and you've got all kinds of engineering issues, certainly you want to get with your lawyer and see what's the best. There's different options for different amounts of damages. That's what I would say. So yes, there's not a limit. It's just how's the best way to go about it. What's the most efficient? I had one. They drove through a $40,000 gate, a big stainless steel gate in South Florida. Drunk driver, no insurance. So could you sue them? Sure. You pay your deductible. They pay out. I mean, if they happen to have a pretty high deductible, so that's the risk you take, right, Bill?
Yes.
There's a question on fining committees. Does a fining committee need to be noticed to owners, and who may attend?
So it depends on what your declaration says, A, and do you have a fining policy in place? So I tend to say yes, they need to, because you don't want to do business in the dark, because it just leads to rumors and it undermines what you're really trying to do. Shauna, I see you're shaking your head. I'm a big fan of transparency, folks. It's just my philosophy. I think that it should be open. I think people should understand why they're being fined. It shouldn't be done in the dark. But again, you've heard me say this several times. What's your policy? If you don't have one, you better get one.
Absolutely.
Somebody was asking about transfer fees.
Mm-hmm.
In HOAs, it's the Wild West. The first place to look is your declaration. You might have a capital infusion type of a clause in there. If you don't, you can amend your declaration to include that. Let's see.
There was one that came in live. How can a homeowner enforce board members to provide HOA documents that have been formally requested by certified mail?
So in both 718 and 720, again, to the bane of some management's existence, the homeowners can request to, now here's the important verb, inspect the official records of the association. So if you make a written request to inspect, the association has an obligation within 10 days to give you an opportunity to go in and inspect those documents if they're part of the official records list. They have no obligation to provide them to you. Now, they may do so because it's simply easier for them to PDF it, depending on what it is, but there's no obligation to provide. There's an obligation for them to make them available for inspection. Both homeowners, HOAs and condos.
Hey, Bill, there's a question regarding reserves. Is the fully funded calculation any different for pooled method versus the line item for reserves?
No, it's just the parameters that you're setting up. So if you're doing the component method, it's going to be actually by component, roof, paving, painting, whatever it might be. The pooled, you're going to just be looking at it in its entirety, but it's still basically the same calculation, a little bit more complicated, simply because of the fact, for example, if you've got a 25-year stretch to replace your roof and you paint every 7 years, then you're going to need to budget in effect funds to take into that account that in that 25-year period, how many times you're going to be painting. So it's basically the same premise, but the calculation is going to be a little bit different, as opposed to, for example, if you went onto the component, you'd only be doing the painting that one time until it comes up the next time.
Yep. So on our side, we would look at the reserve study to see those fluctuations. It would show you everything. Yep.
Right.
On your side, you're looking at just one big pot. On the reserve study side, we would be able to see the breakdown of where we're losing and where we need to gain. Yep.
Yeah, and the pros and cons to that is, you know, you'll hear some people say that the pooled is great, and it's great in the sense that, you know, you're going to have funds available to do a specific project that comes up within a period of time. And if it goes over, it's not a big deal because perhaps, you know, you've got the pool to use. But if it was a specific component method and it was the roof and it was going to go over, you know, obviously you'd need to be able to get a vote then to move some funds out from one of the other projects to actually use against that other. So that's kind of the give and take. And some proponents of the component method will tell you it'll keep the board in check in terms of spending, because it's only allotted a certain amount. You know, you don't have, you know, let's add on this, let's put that on within the project. So it depends.
Yeah, depends. Famous words. No, we got a lot of these. I think there was one I noticed in here. Who to hire to prepare an application for a neighborhood enhancement grant?
That's interesting, because I went into that. I thought that there might be a tax aspect to that, but I had never heard of that in the East Coast. But apparently there's beautification projects that are grants that are given out by communities or localities, if you will. And basically the grants, from what I saw on the few that I read, is a combination of them, of the locality giving you monies for these beautification projects, and then the association kicking in for, you know, the balance of what it might be. Maybe it'll be a 50-50 share. It looks to me like the application that you're putting in is going to take into account your projection for what you're going to beautify there, you know, whether it be plantings or you know, whatever. And it's going to entail, you know, a picture or a view of what's going to be done and what the associated costs are for submission. I don't think it's anything more than complicated than that. I kind of thought about it as a grant initially that you would get, for example, the PPP loan, or, you know, one of these other grants that are coming out of the CARES Act, but that's not the case. It's just, it seems like a partnership between the locality and the association, beautifying some common element within the community.
I think there was one. I don't think we covered this one yet. Did we, Laura? The one on in a condo association, can you make owners use licensed contractors and notify board of work being done?
So that answer is probably most likely already baked in to your documents. That requires that the association not do anything that's against the laws of where they're situated. And if it's against the law to use an unlicensed contractor, or where your building or your association is, then you've got that baked in. So that's certainly, and you can certainly pass some rules to notify the board of work being done and request plans, particularly if you're in a condominium in a high rise and you've got it, again, you've got issues of structure, you've got issues of common water and sewer and electrical. So it's probably baked into your documents. You just need to let people know. It's a good hook to pass a resolution to force that.
Perfect.
I think we've answered everything.
Yeah, I think we got through everything.
Which is great. Last, 1 minute left.
Yeah, ask now or forever hold your peace, at least until the next webinar.
Or at least until you get our email.
Exactly. Yes. Oh, thank you, Keith. I think we forgot to mention that Laura and I will send emails out to everybody who registered before the end of the week. We'll include a link to the video recording, and we will also include the contact information for everybody on today, which is also on your screen right now. So we will, we will send all of that out as well, so you can look in your email for that.
All right. I think we've touched on everything. I want to thank everybody so much. Bill, Jason, Keith, thank you for your time, your expertise, your knowledge, your advice. And I hope everybody has a wonderful rest of their week.
Yeah. Thank you guys so much for joining us.
Thanks for having us.
All right. Take care.
Thanks for having us.
Bye-bye.